Hello friends, welcome to our second blog of Basic Finance series. As discussed in our first blog, in this blog we will be taking insights on the interest rate interpretations, how interest rates are calculated, why bank offer the interest rate in the first place, factors that affect the interest rate. Okay, so this will be in our this blog, which is blog 2. Welcome everyone. To start with, let's start with the definition that of the interest rate that we have already seen. So interest rate by definition is how much $1,000 will earn in a given period of time. Example that we have seen is 10% fixed deposit rate offered by XYZ bank for 1 year. With this bracketed statement, 10% fixed deposit rate by XYZ bank for 1 year, there are two questions that you should ask yourself. First question is why? Why is XYZ bank offering a fixed deposit rate? Second question is how? How exactly bank arrives at this interest rate? Why? And how exactly bank arrives at this interest rate? So let's start with the first question that we have for ourselves, that is why. So the diagram here which you have seen and which many of you must have interpreted already, okay, so this diagram answers our first question, why. So it starts with you and me. People like us have some money which we want to save for our future purpose. So what we do is we go to a bank, we tell them, okay, we want to do a deposit. Bank says, okay, keep the deposits with us. We will give you a 10% interest rate. That is the FD rate. Simple. Bank on other hand, what the bank is doing on the other hand is, it is finding people like us who act as borrowers. So some of us might have a requirement to buy a house, for which we might need to take some loan. So bank is offering us the loan, and we are doing a repayment of this loan in the form of loan interest. So if you have noticed here, bank is giving you 10% fixed deposit rate and the loan interest rate is always higher. So this 2% is the marginal amount that the bank is charging, which is also its profit. Okay, so the difference between the fixed deposit rate and the loan interest amount is the profit of the bank. Okay, so this answers our first question, why is bank taking the fixed deposit or accepting the fixed deposits. Now let's jump over to the second question, that is how. How exactly bank arrives at this percent, that is 10% fixed deposit rate. So let's start this understanding of how the interest rates are derived. So here you see some examples of a US Treasury bills of 5 years, 10 years, AAA, BBB. The interest rates here are increasing. Each rate is increasing primarily because first two are Treasury, second is the corporate, also the maturity factors and the ratings that they have. Okay, so let's take more understanding on this. Okay, so this difference in interest rate is primarily defined by three major factors. First is the default risk, liquidity risk and maturity risk. Let's take one example and understand this three risk. So let us consider person A. This person has kept a fixed deposit for, let's assume, for 10 years, okay, at a 10% interest. Okay, so now let us understand default risk. What is default risk? Okay, so person A goes to the bank. It has kept with the bank XYZ, which is our favorite bank. So he has kept this deposit with XYZ bank. He goes on 10th year and says, okay, give me my deposit back. Okay, let's assume he has kept 1 lakh deposit, $1 lakh as deposit. Now on the 10th year, when A goes to the bank to get his deposit plus interest, bank says, oh sorry, we have bankrupted and we cannot return your deposit. Basically, we do not have your deposit because we have bankrupted. So A runs a risk that his depositor, or where the place he has deposited, or the counterparty can bankrupt. So default risk is nothing but counterparty going bankrupt, and the counterparty is not able to make the timely payments or the promised payments in a timely manner. That is the default risk. Second risk that A runs is the liquidity risk. So let's understand the liquidity risk. So let's assume on the second year, A is in the need of money. So A wants his $1 lakh. He has some financial emergencies and he needs his $1 lakh. Now there is an agreement or a clause that he cannot do early payments. The bank cannot do early payments, or he cannot break his fixed deposit. So A runs a liquidity risk that whenever he's in need of money, he cannot change his fixed deposit to cash. So liquidity risk by definition is receiving less or fair amount value of investment that can be sold for cash quickly. So this is the liquidity risk. Now maturity risk. Maturity risk is something interesting. So let's assume that after 2 years, there was rise in inflation. Now since there was rise in inflation, what banks did was, from third year, they started offering a rate of 13%. But A already has a deposit of 10% for 10 years. So what is happening to A's deposit? A is not eligible for 13 years. A is not eligible for 13% interest. So for 7 years, A is going to lose 3% interest. So A is going to have a loss of 3% each year. So this is basically the maturity risk. So longer maturity bonds have more maturity risk than shorter term bonds, and require a maturity risk premium. So basically, if A had a 2-year bond, he would not have run this maturity risk. Okay, so these are basically the 3 fundamental risk factors that add to the premium of interest rates. So this we have already seen: default risk premium, liquidity premium, maturity premium. A premium will be charged on the interest rate. Now first factor, the nominal risk-free rate, is something new that you're seeing on this slide for the first time. Nominal risk-free rate is nothing but risk-free rate plus the inflation premium. Now risk-free rate is basically a theoretical rate. There is no such rate as risk-free rate. Every rate will have certain risk calculated within it, and the risk-free rate is a theoretical rate which has no expectation of inflation in it. You can imagine risk-free rate like you offer or you give your money to a friend, and in expectation you do not really expect your friend to give you the inflation premium, the liquidity premium. So there is no interest. You just expect that the friend might return the principal amount, and that too he might return the principal amount. There is no interest that is charged. So this risk-free rate is something like that. Inflation premium is nothing but the increase in purchasing power, which will be taken into consideration for the interest rates. Okay, so interest rate is nothing but nominal risk-free rate plus the default risk premium, liquidity premium, and the maturity premium. Let's consider one problem. So here what is happening is a bank or an investment E wants to determine what is the interest rate that they can charge. What is the interest rate that they can charge to their customers, or they can offer to their customers. Okay. So what the bank has done in this case is it has come up with few investments to compare, investment A, B, C, D, and it is going to calculate the X, investment E. What is the interest rate that can be offered for investment E? So let us first calculate premiums. Okay, so first let's start with the liquidity premium. Okay, so liquidity premium, if you see investment C and investment D, okay, so investment C and investment D, so these two investments have the same maturity, that is of 2 years, and the same default risk, that is they both have a default risk of low. Okay, only difference is this: the liquidity for C is high, C is highly liquid, you can easily exchange for cash. D has a low liquidity, you cannot easily exchange for cash. So the difference between the interest rate 2.3 and 2.4 is going to give you what is the liquidity premium that can be charged. So liquidity premium is 0.1%. Coming to the default risk premium. So default risk premium, let's compare investment B and investment A. So investment B and investment A. So they have the same maturity, they have the same liquidity. The default risk for them is different. One is having high default risk, one is having the low default risk and another is having high default risk. So this difference in the interest rate, that is 2 and 2.5, is going to give you the default risk premium, which is 0.5. The maturity premium. Now consider investment C and investment A. Now C and investment A. Okay. Now both have, let me mark it as S. Okay. So both have the same liquidity. C, same. The default risk for both is low, that is S and S. What is different is the maturity. Okay, so the difference between A and C is going to give you the maturity premium. Okay, which is 0.3. So you now have all the liquidity premium, all the premiums: liquidity premium, default risk premium, maturity premium. Now let's try to calculate what can be the offer rate on investment E. Okay, so let's try to get this value. Now let us consider D as our base, investment D. So let's start with 2.4. Okay, now to compare, if you see the comparison between D and E, so it has a difference of maturity. So maturity for E is 1 year higher, so you will add the maturity premium, okay, which is we have added 0.3. Liquidity for E is high, so E is highly liquid, and D is has low liquidity, so you can exchange E or convert E into cash easily. So you are going to subtract the liquidity premium. So this liquidity premium of 0.1 which we have calculated here is going to get subtracted, and the final value that you will arrive is 2.6. So this X is 2.6%. If you offer 2.6, it will be as per market standards. Okay, so this is how interest rates are calculated. So we had asked ourselves a question in our first slide and we have answered it, how we calculate interest rate. So with this, my friends, we have come to our end of our second block. Our next block will be on players of financial market. We have already seen three players, which is you, the bank, and there is one more that we have seen. There are few more players which keep this financial markets running. We will get into details of this in our next block. So stay tuned, my friends. Please do like, share, subscribe. One more thing, this will be a weekend block, so the next block will be on the next Saturday. Thank you. Thanks for watching.